If Social Security is the main money you live on, there's a real chance you're handing a piece of it back to the IRS every year that you may not actually owe. Here's the trap. The income line that decides whether your benefits get taxed was frozen in 1984, and it has never moved since. $25,000 if you're single, $32,000 if you're married. Cross it, and up to 85% of your Social Security can be taxed, even on a modest fixed income. But for 2026, a brand new deduction just landed that can quietly erase that tax for millions of seniors, and almost nobody's been told to claim it. The IRS isn't going to call and walk you through it. So stay with me. Near the end, I'll show you the one short form and the exact deduction that decides whether you keep that money or hand it over again next April. Real quick before we get into it, welcome back to the Finance Scribe. And if this is your first time here, you found the right channel, because this is where we break down the money rules nobody bothers to explain to seniors. Hit subscribe so the next one finds you. And don't just take my word for any of it. The official government pages are linked down in the description, so you can check every number yourself. So let's start with the thing almost nobody understands, including a lot of people who've been retired for years. Your Social Security can be taxed, not by your state, not yet by the federal government. And whether it happens comes down to one number the IRS calls your combined income. Here's how they build it. They take your adjusted gross income, they add any tax-free interest you earned, and then they add half of your Social Security benefits for the year. That total is the number that decides your fate. Now here's where it turns into a trap. If you're single and that combined number lands under $25,000, none of your Social Security is taxed. Zero. If you're married filing jointly, that line sits at $32,000. Stay under it, and you owe nothing on your benefits. But go over, and a piece of your check becomes taxable, up to 50% of it at first, and once you climb past $34,000 single or $44,000 married, up to 85% of your Social Security can be dragged onto your tax return, 85%, on money you already paid Social Security taxes on while you were working. And this part makes people genuinely angry when they hear it. Those thresholds, the $25,000 and the $32,000, were written into law back in 1984. They have never been adjusted for inflation, not once in over 40 years. $1 in 1984 and $1 today are not the same dollar, but the tax line hasn't budged. So every year, just from normal cost of living rises, more middle-income retirees quietly get pulled over a line that was meant for the wealthy. This first part is for anyone whose Social Security is the biggest number on their tax return, because you're the ones most likely sitting right on the edge of it. Now the good news, and this is the heart of the whole video, for tax year 2025 and running through 2028, there's a brand new deduction built specifically for older Americans, and most seniors still have no idea it exists. People are calling it the Senior Bonus Deduction. Here's what it does. If you're 65 or older, you can claim an extra $6,000 deduction on top of what you already get. If you're married and both of you are 65 or older, that's $6,000 each, $12,000 for the couple. Let that sink in, because here's why it matters for the tax we just talked about. A deduction lowers the income the government counts. And when your countable income drops, two things can happen. Either you fall back under that combined income line and your Social Security stops being taxed at all, or you stay over it, but the amount you actually owe shrinks. For a lot of modest retirees, this single deduction is the difference between writing a check in April and owing nothing. Here's what that looks like in real dollars. Say you're a single retiree pulling in around $28,000 of combined income. Without this, you're a few thousand over the line, and part of your Social Security is taxable. Add the $6,000 deduction, and on paper you drop to $22,000 back under the $25,000 line, and your benefits aren't taxed at all. Nothing about your income actually changed. You just stopped being taxed on it, and they made it easy on purpose. You do not have to itemize to get this. Whether you take the standard deduction like most retirees do, or you itemize, the $6,000 is available either way. There's just one limit to know. It starts phasing out once your modified adjusted gross income goes above $75,000 if you're single, or $150,000 if you're married. Above $175,000 single, or $250,000 married, it disappears completely. But if you're living mainly on Social Security and a modest pension or some savings, you're almost certainly under those caps, and this deduction is sitting there with your name on it. One honest thing, so I'm not misleading anybody. This is not a law that erased the tax on Social Security. You'll hear people say Congress made benefits tax-free, and that's not quite what happened. What happened is they handed seniors a much bigger deduction, and for millions of people that deduction is large enough to wipe the tax out in practice. The result feels the same. The mechanism is just different, and knowing the difference is what lets you actually claim it. If you're 65 or older this year, this is the part to write down. Here's what makes that deduction even stronger. It doesn't stand alone. When you turn 65, the IRS already gives you an extra standard deduction just for your age, on top of the regular standard deduction every taxpayer gets. So stack them up. You've got the normal standard deduction, plus the age 65 and older add-on that's been around for years, plus this new $6,000 bonus on top. 3 layers, all subtracting from the income the government is allowed to tax. For a typical retired couple in their late 60s living on Social Security and a little savings, those 3 layers together can cover a big slice of their income, often enough that their benefits never get taxed at all. That's the whole game. You're not hiding money or bending a rule. You're using deductions written into the law specifically for people your age that you qualify for automatically, and that nobody at the IRS is going to apply for you. Being eligible and actually claiming it are 2 very different things, and the gap between them is exactly where people lose money. And if you're a widow or widower now filing as single, lean in here. When you lose a spouse, you often drop from the married thresholds to the single ones, from $32,000 down to $25,000, even though much of your household income stays the same. That shift alone has pushed many surviving spouses into being taxed on benefits they weren't taxed on the year before. The senior deduction is one of the few things that can soften that jump, so don't leave it on the table. Now the form. This is the open loop I promised you at the start, and it's the part most people never touch. A lot of seniors have federal tax voluntarily withheld straight out of their Social Security check every month. Maybe you set it up years ago, maybe you don't even remember doing it. And if your income is low enough that you don't actually owe tax on your benefits, that withholding is just you handing the government an interest-free loan of your own money, month after month, and waiting until next year to maybe get some of it back. The fix is a single short form called the W4V. The V stands for voluntary. It's the form you use to start, change, or completely stop federal tax withholding from your Social Security. If you run your numbers with these deductions and you're not going to owe, you can file that form and stop the bleed. And here's a detail most people miss on it. You're not stuck with all or nothing. The W4V lets you pick how much comes out. You can choose a small flat amount like 7 or 10%, or check the box to stop it entirely. So even if you'll owe a little, you can dial the withholding down to match instead of overpaying all year and waiting on a refund that's really just your own money handed back without a dime of interest. If you can't find the form, or you're not sure what you set up, call Social Security directly at 1-800-772-1213 and ask them what's being withheld from your check. Let me make it real. Picture Harold, 71, a retired diesel mechanic outside Dayton, living alone on his Social Security and a small pension. For 3 years, he had tax automatically pulled from his benefit every single month because a form he filled out once told them to. When he finally ran the math with the senior deduction, his taxable income was low enough that he owed nothing on his benefits at all. That withholding had been pure habit. He filed one W4V, stopped it, and put that money back into his own monthly budget where it belonged. He didn't win anything or game anything. He just stopped quietly giving away money that was always his to keep. If you're handling taxes for an aging parent, or you set up withholding for a spouse who's gone now, this is the part to pause on. Go look at whether tax is still being pulled from that check, and whether it ever needed to be. Okay, let's talk about where you live, because the federal tax is only half the picture. Your state gets its own say. And here's the good news for most of you watching. The large majority of states do not tax your Social Security at all. As of 2026, 42 states plus the District of Columbia leave your benefits completely alone. Only 8 states still tax Social Security in any form this year: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. And even in most of those, there are income limits and exemptions that mean plenty of retirees still pay nothing. The trend is going one direction too. West Virginia just finished phasing its tax out completely this year. Missouri, Kansas, and Nebraska all scrapped theirs recently as well. State after state is walking away from taxing seniors' benefits. So this part's for the folks who packed up and moved in retirement or who are thinking about it. Where you live can genuinely change your tax bill. Which brings me to a real question for you. Which state are you watching from right now? Drop it in the comments because it tells me whose state rules to break down next. And I do read them. And do me one favor before we finish. If your husband or wife is the one who handles the taxes in your house, pause this right now and send it to them. This is the kind of thing that's worth a 2-minute conversation tonight because the money it saves is real and it comes back every single year. One warning before the wrap-up, because where there's confusion about taxes and Social Security, scammers show up fast. Here's the play they're running on seniors right now. You get a call, and the voice says it's from the IRS or the Social Security Administration. They tell you there's back tax owed on your benefits or that your check is about to be suspended unless you pay immediately. Then comes the tell. They want it right now in a gift card, a wire transfer, or a payment app. So burn this in. The real IRS and the real Social Security Administration will never call you out of the blue demanding instant payment, and they will never ask for a gift card. That's not how the government works. If you get a call like that, you don't owe them a conversation. Just hang up. Say it out loud if you need to. No thank you, and put the phone down. Then report it, so they go after the right people. You can file it at reportfraud.ftc.gov or call the Social Security fraud line at 1-800-269-0271. Real help never pressures you. The pressure is the scam. All right, let's bring it home with exactly what to do, in order, so this turns into real money and not just a video you nodded along to. Step 1. Figure out your combined income. Add up your adjusted gross income, any tax-free interest, and half of your yearly Social Security. That one number tells you if you're even in taxable territory. Step 2. If you're 65 or older, make sure you're claiming that $6,000 senior deduction, $12,000 if you're a couple, on this year's return. You don't have to itemize to get it. Step 3. Stack it with your regular standard deduction and the age 65 add-on and see whether your benefits land under the line. Step 4. If you're not going to owe, file a W-4V and stop any unnecessary withholding coming out of your monthly check. If you're not sure what's being taken, call Social Security at 1-800-772-1213. Step 5. Check your state and remember only 8 of them still tax benefits at all in 2026. And Step 6. Never pay a tax to anyone who calls you out of the blue demanding it. Hang up and report it. So let me leave you with 2 honest questions. Have you ever had federal tax pulled out of your Social Security check? And did anyone ever tell you to check whether you actually owed it? Tell me below. I want to see how many of us have been quietly overpaying. One quick honest note before you go. I'm not the IRS, I'm not the Social Security Office, and I'm not your accountant. So treat everything here as plain English education, not financial, tax, or legal advice, and run your own numbers against the official pages linked below. And if this video saved you even $1, do the thing that keeps this channel alive. Share it with one person you love who's on Social Security. That single share might be the reason somebody you care about stops overpaying this year. From all of us here at the Finance Scribe, take care of your money because nobody else is going to do it for you.